I want to welcome everyone to our panel discussion on Asia. What each of you need to know about how to navigate your activities there with these panelists. I'm Scott Wieler. I'm the founder, like many of you, and currently the chairman of DC Advisory in North America. Delighted to be able to introduce the panelists and have them share their perspectives on demystifying, Asia. At the far end is my partner, the CEO of DC Advisory, in Europe, Richard Madden. He's an advisor of choice to corporations and private equity in the TMT space with 35 years of experience, and probably 50% of his work is cross-border, in nature. Jen Isayama, next to him, to his right, he's the CEO and founder of Miel, which he's going to talk about, and it's a fascinating ecosystem of venture. He's passionate about entrepreneurship and creativity, and he founded his first company in college. He's a columnist and a frequent speaker around technology, in Asia. And next to him, and to my left, is Oskar Miel. Oskar is the managing partner of FinTech and Mobility Investments for Rakuten. On top of that, he's a top decile investor in this category. And so between Lyft, Cabify, and others, a pretty interesting collection and perspective. So we're going to open it up, and I'm going to start and ask Richard the why. Why should all of you care? What is this about? What's the magnitude, of Asia activities, in the market? So Richard?
So Asia has become increasingly important for us. Look where the money is. Because when you look at M&A, it is frequently driven by money, but it's also driven by globalization. So as people want to know markets better, as people want to get closer to their markets and invest in IP, you see significant international M&A. And you can see on the board, we've got from Asia to US the last 5 years, we've got 1,500 transactions. It's about the same Europe to Asia. There's 2,000 Asia into Europe transactions in that period. So it's a very, very busy market. And if you don't understand that market, you can't make the most of it.
And Richard, is it a wave or a series of waves?
Yeah. I mean, Asia it's a bit like saying the Americas, because I don't think there are two nations more different than the Japanese and the Chinese. And those are the two largest investors out of Asia and into Europe. So there are two fundamentally different things going on in those markets, and there's more different things going on in different markets across Asia. So it's a very large area with very, very significant differences in practice.
So Jen, maybe you can share for a few minutes what is it that the Japanese and the Asians are really seeking, in their investments?
Yeah. So, today's theme's about Asia, but, there's so many countries in Asia to just talk about in 30 minutes. So let me focus on Japan that you specifically talked about. So my firm actually is trying to help Japanese corporates to connect to, other parts of the world, particularly the startup ecosystem,
right,
as a lot of Japanese corporations have a long history, very stable, living in a very stable economy. Therefore, they're having a challenge to change the way they do things. So I have an office in Palo Alto with a lot of 20-some Japanese corporations trying to search for technologies in startup to, trying to change the corporate culture through learning something from these startups. Now, bringing up Japan in a situation like is not a very popular topic, because when we talk about Asia, everyone thinks about China or
right,
India or Southeast Asia maybe. And Japan seems to be, we use the word passing or ignoring, because if you look at Japan 2000, let's look at China from year 2000 to 2018, their GDP 10x. In India also, not 10x, but they grew very rapidly. Also United States, 2x GDP in this 18 years. And Germany or South Korea, they also doubled their GDP in 18 years. So now Japan, what do you think will happen? 2000 GDP Japan, 2018. What do you think?
Not much.
Flat, or it actually went down. one of the very few economy in the world compared to 2000, 2018, which went down. Yet, one of the most strange mysteries is that when you go to Japan, everyone looks happy. Everyone seems rich, right? Everything looks clean and cool. And what do you see this? When everyone is doubling their economy, Japan was flat or it was going down. So what does that mean? Okay, that means Japan still third largest economy, still rich country, very stable, society. Therefore, people are okay with living a lifestyle, drawing a future based on what they did in the past. What does that mean? There's no innovation. So right now we're seeing after 2 decades of zero growth, I think we're seeing a tremendous potential to change how things could be done in Japan, where there's still a lot of wealth in the society.
Oskar, maybe you can comment on interest sectors, capabilities. What are the Japanese looking, kind of to do and to acquire?
Sure, I find it kind of interesting. I don't know, can everybody see the chart, by the way, or on the screen, or not?
Yes. Yeah, they're seeing.
Okay, great. Yeah, because funny enough, I guess we're talking about China or Japan, and I guess the current administration must have been already very successful keeping China at bay, since you don't have any Chinese representative on this panel.
Right.
But I kind of wonder what the percentage of dollars invested coming from China historically has been vis-a-vis Europe and the US. And I would claim it's probably a fairly large number, meaning, what we've seen here, putting sectors to the side, has been a bit more cyclical in the sense, depending on where the economies have been, and obviously Japan was a giant back in the 80s, and
right.
that role was progressively taken over by China, and effectively it's not even sector specific. I think again, just put it in a very right way. The answer is in innovation. Right. What we've seen is that the flows have been effectively driven by corporates, VCs searching innovation, searching for new ideas, which have tended to be more advanced in the West, especially in North America, and that's why if you look at semiconductors, right, there's also that big battle about whether the Chinese can win the race or not, and they still appear to be a couple of years behind, and that's why we're trying to be so protective of the technology. But essentially, there's been a huge amount of capital, a lot of growth. As Gen said, there's no Asia, there's very different countries within Asia. And also, I was just in Korea with my colleagues this week, and when you talk to the large conglomerates, everybody's trying to get out of Korea precisely to also find new ideas to stimulate growth within their own nations. So what a lot of these countries are trying to achieve is effectively finding tools that will revitalize their own economies, and that's why we're here.
So we've always said that the world is awash, kind of in liquidity, right? And in a variety of these markets, there's excess liquidity that needs to be reinvested, kind of for growth. Richard, could you talk a little bit about, how Asians think about, kind of valuation, kind of for, kind of investments, and how it's different than so much in the West?
So before I do, I'm going to pick up on something Oskar said, which is actually there's a different element that happens in China to anywhere else in the world, which is regulation. And so actually we're seeing Chinese outbound M&A has declined in the last couple of years because the government has put a very, very firm throttle on speculative outbound investment and has effectively said there are really only 5 sectors in which you can invest. And not only that, you have to have your money offshore. So that market is a very different one. And if you look at the numbers again, you don't see much China into the US because it's not welcome in technology.
Correct.
And therefore, there's treating the Chinese and treating with the Chinese is much, much more complicated because there's so much happening outside the room that you know pretty much nothing about, and which the investor themselves will tell you things that may not quite be true. Anyway, so, but in terms of valuation, I think in almost every process that we run with European assets where there is Chinese interest, and that's probably half of the transactions we work on, there is Chinese interest, and a very small percentage of those complete. But in terms of valuation, it's hard to say because the Chinese approach is a bit like the American approach, which is in a bidding process, I will tell you the biggest number I could possibly make up, and then I will buy myself exclusivity, and from that position, I will drive the price down. So it's a very different way to the way that the Japanese approach valuation, because the Japanese approach to valuation is to think really, really thoroughly about the strategic import, the strategic impact, the product fit first. Everything becomes all about the product, and the valuation is really the last thing that matters, because if it's essential for Japan, then they will pay the price.
I'd like to differ. So I think
that's why we have a panel.
Yeah.
Right?
Well, maybe that used to be historically the case, especially, because of language barriers, culture, precisely, the ulterior objective of getting a deal done. I think there was a perception that some of the Asian money was effectively dumb money.
No.
But we've seen that, right? When we've come into a room and it's like, oh, we'd like you to invest, and it's almost like valuation is a given and this is the price. I think things have become much more professionalized right now, and effectively, whether you take Japan, China, or any other nation right now, the teams are very, very strong, and almost wherever you go, people think in a very similar fashion right now. So that has very much reversed to the mean, and everybody's trying to negotiate in a very tough way, trying to extract the best number.
I agree. I mean, I do think, however, that with the Chinese, there is still a premium for trophy assets. There are still assets that have that cachet, Wentworth Golf Course, for example, in the way that Japan in the 80s bought golf courses. Yeah. But I think with the Japanese, I still think, 10 years ago when I first did a lot of work with the Japanese, it was all about net assets. And it was all about the balance sheet. And now it's moved into a much more earnings-based approach. And so it is much more rational, I agree.
But the time frames, kind of in view about the future, kind of are quite different,
yes.
Kind of relative to both China and Japan and how they look at, kind of investments and returns. Jen, could you take a minute and talk a little bit about your Will ecosystem and the Japanese partners and what they are really trying to accomplish, kind of working with you, kind of here in the Valley?
Yeah, touching on what we were just discussing, I think Japanese still tends to be long-term when you think about investment. I was joking, Japanese love to buy at high and sell at low, which doesn't make any sense. But it used to be that way. But now, yes, people are becoming more and more cautious about valuation. Yet, if I compare with Western, corporates who are trying to acquire, Japanese tend to think long-term. I guess we analyze, is it this farming culture that we inherited versus hunting culture from the Western? Yeah. But anyways, it's longer term. So what I see from the corporate when I'm working with them is, yes, of course, they care about the short-term benefits of acquiring or investing overseas, but always the tipping point is always, how is this company or technology going to benefit them long-term? Mm-hmm. Not only for business, but actually to transform the corporate culture. Because when you work with an outsider, it's going to change your corporate culture. And it's not just about making extra sales or, making your, cost down. Working with a startup would inevitably change how you need to work with outside parties. So that is much big. That weighs a lot more. That weighs not a lot more, but that weighs a big piece of, when you talk about investment or acquisition, and that's plays a significant role. It's interesting about Japan is that, in this past 2 decades where there was no growth, Japanese corporate are sitting on unprecedented amount of cash today. It's surpassed $1.8 trillion today. It's huge, ginormous amount of
We're
cash.
not going away. We're still here.
It's still Ferrari.
Yeah, it's a Ferrari.
And the government pension is still the largest sovereign wealth in the world. It's $1.5 trillion too. So if you combine those two, we're sitting, the country is sitting on a huge pile of cash and investment to go somewhere. So I'm hoping that those dollars will be invested overseas for the long-term innovation or long-term growth of the country going forward. But it's very different from some of the dynamics that we hear about the other parts of Asia or U.S. or Europe.
But again, it gets back to this notion of liquidity, excess cash flows redeployed for growth. What are attractive markets? Where should they be? Kind of in the U.S. and Europe are kind of attractive markets.
Yeah, for technology, definitely still, the reason why headquartered in Silicon Valley of local places is that it still works as a think tank for what's happening in the tech space.
Sure.
And of course, you can start startup in Estonia or wherever you go these days, but the know-how and the emerging tech still continues to accumulate in the valley. So that's a great spot for me to at least identify and understand what's even happening in Asia too.
Oskar, could you spend a minute talking about kind of your views around corporate venture capital versus kind of fund-based kind of venture active shareholders versus passive shareholders, kind of how you think about kind of that?
Sure. That's also, I guess, the convergence between, I guess, independent or traditional venture capital and corporate VC is another one. Is another one of the trends, or I guess like reinforces the trend that we have been talking about before about professionalization, and also how, yes, on the one hand you have corporates that are trying to bring the innovation in-house, except that historically the failure of CVC has precisely revolved around making those investments too strategic. Meaning, by the time we find an opportunity, if you're trying to find a synergy, that opportunity probably would have traded away.
Yeah, you've missed it.
Especially, in the Japanese corporate environment where things are a bit, slower than, let's say, elsewhere. So the only way to succeed, and that's what we've done at Rakuten Capital, we have about 3 billion of AUM. About 95% of that capital is actually deployed in the US and in Europe. And effectively, we have acted as any type of independent VC. I mean, effectively,
Yep.
we get rated based on the returns that we bring in. We have an IRR of 28%, which is actually much higher than the average. And yes, it's not completely detached from the corporation. We never say that, except that comes thereafter. Once we've made an investment, if there is any type of synergy that we can bring and connect to our business units, we will do that. But that will be done at arm's length. Mm-hmm. I firmly believe that if you try to do it the other way around, it actually does not work. And startups evolve very, very quickly. So again, you might be investing in a corporation for a strategic reason, and that startup might have morphed into something else once you find it.
Richard, everyone in the room has heard a horror story about trying to do a transaction in Asia. Okay, 60 people in diligence rooms, kind of or otherwise. Could you talk for a couple of minutes about some lessons learned about how you need to run processes differently to be able to be successful with cross-border transactions into Asia?
Yeah, I mean, again, it's quite different for China to Japan. If you start with China, I think you need to be aggressively standoffish to begin with, because you need to ensure that your Chinese investor has the cash. You need to ask them where it is, how they're going to get offshore. You need to be very clear about how they're going to get their permissions lined up. So before you even start, you have to address those difficult questions that we tend to find embarrassing. Asking people whether they've got the money feels rude. But if you don't, you may well end up with a failed process. So with China, it's all about getting things done early, about the financing. With Japan, likewise, it's all about getting things done early. Because the decision, unlike with private equity or indeed with Western strategics, the decision is probably made late as to whether this is a good deal and is based on very, very significant amounts of information. And therefore, you need to do your diligence long before, or you need to allow the Japanese to do their diligence long before you would in a normal westernized process. And you need to build a relationship of trust over a significant period of time, which feels difficult. And frequently you get people say, I just don't want to invest the time in that. And therefore, they have to understand why it's worth their while to invest the time. And I think as somebody who is owned by, well, as a firm owned by the Japanese, it can be a very worthwhile experience because that long-term view and that long-term investment changes what you can do with your business. And I think if people get that early on, then it's worth the time investing in making sure that the Japanese bidder can get there on time.
Yeah, drinking and golfing works. Right?
Well, but drinking and golf, it's interesting. The things you don't do when you drink or play golf is talk about business.
Yeah.
This is about building trust and building the social connections that make the culture work.
Yeah. No.
So Jen, I'd like to, again, I'd like to ask you to talk about a success and or a failure, kind of in this work, and what are the lessons learned for all of us?
Yeah. Again, I'm going to only talk about Japan since that's been my focus this past 5 years, but I think the failure is often, you think all these big transactions, whether it's M&A discussion or big business deal or investment, you're only looking at the CEO. Assuming that he or she says yes, everything would follow, but it's not as simple as that. In Japan, I would say the rule of thumb is there's two big camps. One is the large corporations still controlled and influenced by the founder family, and the other path is hired CEO. So there's a very different approach depending on it's still family-run business or it's not. Family-run business, yes, the founder CEO or the family members have unfair advantage over to influence any major decisions. So of course you want to golf and drink and do all the craziest stuff to win the trust and do the bonding. Now the hired CEO are professionals and they listen more to, let's say, independent board members. So my audience is not only the CEO, but it could be the independent board member who come to the board meeting once a month. So depending on what you are trying to achieve, the constituents you need to address could be very different, and you could be looking at the wrong person. So it's not always just the CEO or the person with the highest title. Depending on what you're trying to do, you need to decode the history almost of the corporation and understand who are the influencers, and then ask whether you need to bring a wine or sake or golf club to do these things right.
Golf clubs would be helpful.
Yeah.
Oskar, success or failure? A lesson learned.
Well, I would say again that it is about how professional you are in terms of your approach. In our case, I think history speaks for itself. The companies that we've invested in, such as Lyft, Pinterest, Upstart, Bluevine, Kareem in the Middle East, you name it, right? All those are great success stories. There's nothing revealing in terms of how we found those. You look at the big opportunities, growth markets, great technologies, but more importantly, great management teams. And that's effectively what makes or breaks a business. So if you have, I guess, a mediocre opportunity with great management, or a great opportunity with mediocre management, you always go with the former.
There's a reason why he's a top decile investor.
I'm going to take
Richard.
a success because we haven't, with China. And it's about really understanding what is the strategic imperative, not of a company, but of the state. And so if we look at a couple of successful transactions that we've done, we raised money out of China for a business called Punch Powertrain, that is a automotive manufacturing supplier, going into the Chinese market when there's a massive expansion of the automotive market. So that's perfect. The second one is that, as you probably know, Beijing has the Winter Olympics. They are building ski resorts like you wouldn't believe and trying to encourage their own people to ski because they've never done it before. So what have they done? We, advising Rossignol, the ski company, have taken investment from China into skis, and they've invested into Arc'teryx, which is, again, so if there's a big theme, Chinese money is a good place.
We're going to take a question from the audience, and then we're going to be done. One? Anyone? Going once? Twice? Thank you very much. We appreciate your time.